High rates do not hurt everyone in the same way. The person with debt and the person with cash live in two different economies.
Welcome to Dragon Bullion. The first lesson today is simple. Interest rates are not one single experience. A higher policy rate can be painful for a household with floating rate debt, a small business that needs credit, or a real estate investor who depends on refinancing. But the same higher rate can be useful for a cash-rich retiree, a company with little debt, or an institution that can park money in safe instruments and earn real income. That is why investors should stop saying high rates are good or high rates are bad, as if the whole economy is one person. The better question is, who owes money, who owns money, and who can wait? When rates rise, time becomes expensive. Borrowers lose flexibility because every month of delay costs more. Cash owners gain flexibility because every month of patience can earn interest and create optionality. That difference becomes a market force. It changes who must sell, who can buy, and who survives a long correction. The opposite scenario is also important. If inflation is still higher than deposit yields, even a high nominal rate may not protect purchasing power. In that case, cash feels safe, but real wealth can still leak away. So the investor checkpoint is not only the headline rate. Watch real rates, inflation, debt service, and the currency. Debt is the channel that turns a rate change into daily pressure. A company with strong cash flow and fixed rate debt can survive a higher rate cycle. A company with weak margins, short maturities, and refinancing needs may not get the same time. For households, the split is just as clear. A family with a large variable rate loan feels the central bank immediately. A family with no debt and a cash buffer may actually see more income from deposits and money market funds. That is why the same macro headline can create completely different behavior inside the same country. This matters for markets because forced sellers usually set the ugly price during stress. When rates rise slowly, the pressure is not always dramatic on day one. It can become a long grind. Refinancing gets harder. Consumer spending weakens and companies with weak balance sheets start cutting investment. But strong balance sheets can become stronger. If competitors are forced to retreat, cash-rich firms can buy assets, hire talent, or wait for better entry prices. Investors should therefore separate balance sheet quality from story quality. A good story with bad debt can fail. A boring business with cash can become powerful in a tight money cycle. Cash has two faces. In a panic, cash is an option. It lets you avoid forced selling and buy when good assets are marked down. But in a long inflation cycle, cash can become a melting asset if the bank rate is lower than the inflation rate. This is the key to understanding Japan's long low rate period. When deposit rates stay near zero for years and the cost of living keeps rising, conservative savers slowly realize that doing nothing is not neutral. Holding cash can become a quiet loss. That is when money moves. It may move into domestic equities, real estate, foreign assets, dividend stocks, pensions, or structured products. The movement does not require everyone to become a trader. It only requires enough cash owners to decide that bank deposits no longer protect purchasing power. The risk is that this movement can push asset prices up faster than earnings. If money leaves deposits because cash feels bad, it may buy equities even when valuations are no longer cheap. That creates a rich owner market. People with assets look richer, people with wages feel squeezed, and the social gap widens. Japan is useful because it shows what long, low rates can do to conservative money. For a long time, many investors treated Japanese cash behavior as permanently cautious. But when inflation appears and deposit yields stay low, the calculation changes. If the bank does not pay enough to protect purchasing power, the cash owner needs another store of value. Stocks can become attractive not only because growth is exciting, but because cash has become unattractive. That is an important distinction. Sometimes the buyer is not chasing a dream. The buyer is escaping silent loss. This helps explain why asset markets can rise, even when ordinary consumers do not feel rich. The money entering assets may come from people and institutions that already own capital. The stock market can look strong while the wage economy feels tight. That is not a contradiction. It is the ownership structure showing up in prices. The investor mistake is to assume that a rich owner market can continue forever without earnings. Eventually, asset prices still need cash flow, margin, buybacks, dividends, or policy support. When rates begin to normalize, the same money that moved out of deposits can reconsider deposits again. That is why the rate path matters as much as the level. Korea offers a fresh test case because the market recently saw domestic money move aggressively toward equities, while the currency and inflation stories stayed important. When people worry that cash is losing value, they look for assets that can protect them. Large semiconductor names can absorb that attention because they are liquid, familiar, and connected to global AI demand. But that does not mean every entry price is good. A high-quality company can still have a low expected return if too much money has already entered. The Korean example also shows why the currency matters. If the won weakens, imported inflation pressure can rise. If the central bank needs to defend purchasing power, the rate path can become more restrictive. That can pull some domestic money back toward deposits, bonds, or cash-like instruments. So, the lesson is not simply buy Korea or sell Korea. The lesson is that domestic asset flows depend on the relative pain of holding cash, holding debt, and holding equities. Watch the currency, the deposit rate, the real rate, and the behavior of large domestic capital. The yen carry trade is often explained too mechanically. Borrow cheaply in yen, buy higher yielding assets somewhere else, and earn the spread. That is the basic idea. But the real market danger is not one small rate hike. The danger is a change in direction. If the Bank of Japan raises rates once and signals that it is done, global investors may treat it as a limited adjustment. But if inflation, wage growth, and central bank guidance suggest a continuing path, every carry position has to recalculate. The funding currency can strengthen, the spread can shrink, and the volatility of the trade can rise. That matters for US assets too. If money was comfortable borrowing yen and holding US equities or bonds, a sustained change in Japanese rates can reduce that comfort. At first, US markets may hold up better than more fragile markets because liquidity and earnings are deeper. But a persistent carry unwind can eventually reach the core. The investor checkpoint is therefore not the exact number of one Japanese rate decision. Watch guidance, wage data, inflation persistence, yen strength, and whether global risk assets begin moving together. Carry trades break slowly, then suddenly. The next lesson is market cap math. Price alone is a trap. A coin trading at $1 is not automatically cheaper than a stock trading at $500. A stock at $50 is not automatically easier to double than a stock at $200. The question is always market capitalization and the amount of money required to move the asset. This applies to crypto, semiconductors, platforms, and any large asset. If something is already huge, doubling it requires a huge amount of new capital or a huge improvement in expected cash flow. That does not mean it cannot rise. It means the hurdle is higher. The same logic protects investors from emotional targets. Saying a coin should go to $10 or a megacap stock should double again sounds simple until you calculate the market value implied by that target. The math forces discipline. The opposite scenario is that a smaller asset can be cheap for a reason. Low market cap is not automatically opportunity. It can also mean weak liquidity, no earnings, poor governance, or no buyer base. So market cap math is a filter, not a complete investment thesis. One of the hardest lessons in investing is that a good asset can become a bad trade. A company can have strong technology, a real customer base, and a powerful industry position, yet still offer poor expected return if the price already reflects too much optimism. This is where rates and market cap connect. In low rate periods, investors can justify paying more for future growth because discount rates are low and liquidity is generous. In higher rate periods, the same future cash flow is worth less today, and the market asks for proof sooner. That is why late buyers need a different rule from early buyers. The early buyer may hold a core position through volatility because the entry price is low. The late buyer may need to reduce into rebounds, avoid leverage, and demand more evidence before adding. This is not pessimism, it is position management. The market does not pay investors for loving an asset. It pays investors for buying the right risk at the right price with the right time horizon. Use 5 checkpoints. First, separate debt owners from cash owners. If a sector depends on refinancing, treat higher rates as pressure. If a sector holds net cash and earns interest, the effect can be different. Second, watch real rates. A deposit rate that looks high can still be weak if inflation and currency pressure are higher. This is why savers may still move into assets even when nominal rates rise. Third, watch the central bank direction, especially in Japan. One rate hike is not the same as a hiking cycle. Guidance, wages, inflation, and yen strength matter more than the headline alone. Fourth, calculate market cap before setting price targets. Ask how much new capital, revenue, margin, or adoption is required for the target to be reasonable. Fifth, separate the asset from the entry. A strong company, a strong coin, or a strong theme can still be a poor buy if the expected return has already been taken by earlier investors. The core lesson is direct. Rates divide the economy between debtors, cash holders, and asset owners. Japan shows how low rates can push conservative money into assets and how normalization can make that money rethink the trade. Carry trades depend on direction, not one isolated rate decision. And before you believe any price target, calculate the market cap.